the big event of the week is Wednesday's FOMC meeting. That is the Fed. Investors are expecting the Fed to pause monetary tightening. According to the CME FedWatch tool, investors are pricing in a 70% chance that Powell holds steady on rates through the end of the year before making cuts. And our next guest agrees that we may be at the end of the tightening cycle. So joining us now is Marvin Lowe, the State Street Senior Global Macro Strategist. Thank you for joining us here today. Just give us our top level view, kind of in broad strokes, what you might expect, what we might expect from the Fed and Jerome Powell tomorrow.
Yeah, for sure. I think the market is correct in expecting the Fed to skip this meeting, not necessarily pause the hiking cycle. Some of the commentators just before me talked about inflation. They talked about consumer strength, and I think that's going to require the Fed to maintain its vigilance. Ultimately, they'll keep what we say is optionality for another hike before they're done with the tightening process. And then the focus becomes on if there's a different signal with regard to the pace of cuts next year. I think that at this point, the inflation story is not well packaged. I don't think the Fed is comfortable that they're going to get to 2%. So while I don't expect any changes to their view for 2023, which at this point includes one more hike before we get to the peak rate, the terminal rate, if you will, they might signal that they're not going to cut as aggressively going into next year. So this higher for longer message is probably where we're starting to see concerns around interest rates being volatile, being higher, if you will, over the last couple of days, and a little bit of the volatility within the equity markets as of late.
So, Marvin, let me ask you to expand a little bit on the expectations for 2024, especially when you keep in mind where the dot plot was at the last meeting. And that was before we had new inflation prints come in, showing inflation was heating back up after it showed some cooling. So what would you say is where your expectations stands in terms of so the projection based on the last dot plot was we would see a cut maybe in spring of 2024, right? What's the expectation for your view now? What are you preparing for?
Yeah, so I think the dot plot was signaling that we were going to have an aggressive second half of 2024 with regard to cuts. It really needs to tie into what their economic projections are. So one of the glaring, I think, concerns that the Fed has is that the employment market remains tighter than they expect. They expect the unemployment rate to get to 4.5% by the end of next year. And given how strong the jobs market has been, even though we've seen a slowing of it, they might not feel comfortable with that number. If they actually lower their unemployment number, does it mean that growth is a little bit better because there are more people that are working? Does it mean that inflation is a little bit hotter? That ultimately would form the basis for potentially thinking that it needs to hold rates higher for longer, even though what we've heard from Chair Powell as well as some of the other speakers is that they think that rates are restrictive already at this point. They think that the current interest rate is one where the economy should slow. It's just we have a lot of post-pandemic things that we're still working through. Some of them might be structural. There are less people that are working, and others might just take time. The amount of savings that is still in the economy, which equates to liquidity, which has to be drawn down in order for policy to really reflect what they're trying to do.
And Marvin, nevertheless, we have the 10-year rate just screaming north, 4.34%, right at the highs over the last 15 years. You'd have to go back to the global financial crisis. Is the 10-year done? We had Jamie Dimon coming out last week and saying he could see it at 5.5%.
You know what? I'm not in that camp. I do think that we could potentially have a little bit more creep up in rates, but not to the degree where we're talking about a 5 handle. The market is volatile. It's trading around each of these headlines. Every data point is live, as the Fed likes to say. It's looking at every data point. So, can it push up to 4.5%? Yes. What we're seeing is that our real money investors that we talk to, there's demand for yields at these levels. They like these levels. So I think ultimately that contains it. Although, if you're looking to play yields going back into the 3%, if you will, which would be certainly positive for your bond portfolios, I think it's premature to really think that that's the case at this point.
And Marvin, I want to dial back to kind of where we started our conversation and where expectations are, right? So the majority, over 60%, are expecting the Fed to skip at this meeting. But last week, that number was 90%, right? 95, 98%, something like that. But there have been surprises before. Generally, Powell signals what's coming. Are you prepared for a surprise?
You know what? I would be very surprised if there was a surprise. The two surprises would be for them to say that they were done hiking. I don't think the CPI number and the strong GDP expectations that we have for the third quarter, kind of seeing how data is coming in, will allow them to say that. The other surprise would be for them to hike and signal that they're going to be more hikes. That would be probably the most challenging for the market. It would certainly push, the view that the Fed funds rate could get to 6%. I think that the signaling that they've had, both from Jackson Hole as well as the more hawkish members of the committee, are willing to see how things evolve. There are 2 more meetings this year. They have 2 more opportunities to hike. The market probably could absorb 1 hike without too much of a change. But again, if they signal that the jobs market is still too hot, this kind of inflation print, which reaccelerated a little bit last month, is something that we're so concerned with that we actually think we need 2 hikes in. Then I do think that we're in for some volatility on the risk side of things.
Yeah, really, really interested to see how core and also headline inflation react next month. But we're going to have to leave it there. Yeah. Thank you, Marvin Lowe, State Street Senior Global Macro Strategist.